Good afternoon for those of you joining us for the first time. My name is Roy Weiler. I'm the Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, give us a call at 800-519-9085. We can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so we can prepare a lesson plan based upon your level, at your pace, and on your schedule. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have a question or trade ideas, please type them into the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of the Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing broker Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without delay, welcome to our long strangles, long straddles, when to use and how to calculate webinar. Mr. Mueller?
Hello. Thank you for the introduction. This is Adrian Mueller, and today we get to do some of my favorite trades insofar as they take into account that these are the types of trades you do when you have no clue about direction. So I think that direction is extremely difficult, as many traders know. So these are trades, and as we will see very shortly on our grid, that go in any market. Just to remind you, this is our input. This is where everything starts on the Option Ranger software. We have the multiple calculators, whether they're stock option, stock spreads, futures options, future spreads, and all markets in the master combination calculator. You can follow by markets so that you can look up information on different markets and contract specs and select trades accordingly. You can go to our strategy gallery, which we'll do shortly, which explains what types of trades should be contemplated under what sets of circumstances. And in fact, we're going to go there right now. And as you can see, we have a grid which consists of two principal areas. One is direction, and I think we all have a sense of that this is how people pick their trades. They think the market's going up, they think the market's going down. That's a directional outlook. You can also have an undecided or neutral directional outlook, and that's really the types of strategies that we'll be reviewing this week. They're all going to be strategies in which direction is not our reason for getting in. We don't know where the market's going, or we think it's not going far. Then you look under the undecided column. And as you can see there, and these are the strategies we're going to review this week, there are four strategies: a long straddle, a long strangle, a short straddle, and a short strangle. What these trades have in common is that all of them contemplate that there's not an understanding of direction, but there is an outlook of a change in volatility. So the long premium trades, the long straddle and the long strangle, these are the trades to which you would look if you have an anticipation of rising volatility, and as the image implies, you have a slow market that's kind of struggling sideways uneventfully, and then all of a sudden big things start happening. That's rising volatility. Rising volatility occurs when prices move a great deal, and in options, rising volatility occurs when there's anticipation, nervousness, anxiety in the market, and in many cases a strong difference of opinion about which way the market will go. So for today we will be reviewing the long strangle and the long straddle, both of which consist of buying a call and buying a put. They're volatility rising trades, and let's look specifically at the long strangle that we will start with. You have the visual here, which we'll understand much better when we put numbers to it, but let's go ahead and begin with the basics as they are described. Again, as I mentioned previously, we think a market is consolidating, and you think there will be a big move in either direction. Doesn't matter which way it's a big move, as long as the move is large enough. This strangle, which is a two-directional trade, you're just betting that the market's going to break out big in either direction, would make money. Your profit is unlimited and are achieved if the market moves radically up or down. Again, in this particular scenario, the bigger the move, the more explosive the move, the better the strategy. Your loss is limited because when you buy options, when you're long premium, the most that you can lose is the money that you spend for those options, which consists of your premium that you pay and the fees that you pay. Again, this is a limited risk trade, and your largest losses, your maximum loss will occur if the market stays flat, you do not offset positions to salvage premium, and the positions expire worthless. Time decay is definitely not on the side of the trader in this case. Decay works against the strategy because, and it increases as we get closer to expiration. So as I indicated before, exiting the market before expiration is encouraged. Otherwise, you may end up with a trade where both sides, through time decay, become worthless. If any of you know the Rolling Stone song, "Time is on my side," that is not the case when you are buying premium. That is in any type of long premium trade, and certainly in the case of a long strangle and a long straddle. So what we are looking for, again, is to overcome the premium paid on both sides by an explosive move to the upside or an explosive move to the downside. And again, you have a short narrative here to remind you of the trade in the strategy gallery. Make sure you understand your risk, reward, your scenario, and then if your scenario matches with the trade, we can go directly to the master combination calculator, where for purposes of illustration, we've already saved some trades along with some previous trades that we will be following up tomorrow. Tomorrow we're going to follow up some of the trades that we've been demonstrating the last week or two to see how the volatilities have impacted positions and to see intrinsically if any markets have moved to an interesting spot. For today, let's begin with a long strangle. And in this case, let's begin with something in the bond market. I'm going to go ahead and click on it. Until you know how to save your own trades, and you can learn how to do it using our demo videos and going through our tutorials and video library, we can actually save some of these trades to your tab so that you can look at your spreadsheets and figure out how these trades work, and then gradually you will input the trades yourself and set your own tabs. You'll also be able to monitor premiums and prices using an accompanying platform that can update prices, and you can request that will make that available to you. In this particular case, again, we're looking for a market to break out in a big way, in this case, to go above 134 well and to go below 130. For purposes of illustration, let me just kind of show you where this trade is, and if I may, just a moment. Go ahead and pull that out. Okay, here we go. This is the type of a scenario, as you can see, where the markets sometimes have made very large moves. So you would be doing this kind of trade if you expect a period to come up during which there would be a large move with rising volatility when you don't know which direction it may be. So you'd have to measure the premiums, you have to measure the volatility. So let's say somebody who looked at this chart said, well, I think the market's going to get to one level or another, let's say 125 or 140. And these are just arbitrary numbers for purposes of illustration. So let's see if somebody had that opinion and they put this trade on intrinsically, where it would take them. Well, first we get the basics on the trade. As you can see, we're talking about a T-bar. It's a long strangle. We input a certain number of rows, and let's say 60 rows. The composition of the trade is input automatically. So once you pick a long strangle, the default boxes for buying calls and buying puts come out on their own, to avoid any input error. So you know you're buying a call, you're buying a put, that's the composition of a long strangle. Then the only thing we need to do is input the strike price, and remember when you click on the strike price, you have a dialog box that shows you how to input the strike price. And if you need further explanation or review on the strike price, just click on the Learn More button and it takes you to an explanation. Likewise on the premium, when you click on the premium box, even if the premium is not entered there and you want to make sure you're not enter premium, the premium example is listed here again, so you know how to enter premium. So 2 basis points would be 2.0. In this case, we have 3/4 of a basis point, so it's 0.75. And again, for further explanation and discussion, you can click both on the Click More symbol, or you can also go to the contract specs. Then obviously the trade was calculated, and in this case, the person who set up the trade saved it under a tab so that we could find it here under long strangles. You can also email this trade to a friend. You can save it under a tab as we did. You can print it so that you can look at the numbers, maybe put them alongside of a chart, and you can post them to a forum for feedback from other traders and other people who are testing and using the program. The next thing we get that's important is, is a summary box where we get the composition of the trade, buying a call, buying a call, buying the put, which would be the proper composition. And let's see if we get the proper break-evens here. Okay, we are collecting 2 things. We are spending $750 on one option, $700 on the other, so that the net outlay in the trade is $14.50. We factor in a default commission, so the net debit on the trade, the person who does a long strangle is always paying a debit, is always paying premium, and the break even on this particular trade on a drop intrinsically on the futures is 128.44, and on a rally is 135.56. That's because we add to the futures price or subtract from the futures price the amount of premium that we paid, including the cost, so the total debit on the trade, so that we can calculate our break-even intrinsically on the futures. So ideally you would want to see the market as quickly as possible break above or below these 2 numbers, and throughout that time monitor the premium, 1.56. As we say in our strategy gallery, if the market doesn't go your way, doesn't start making that big move, you might want to consider salvaging premium, because otherwise if the market doesn't break out in either direction, that spread will expire worthless, in which event you would incur the maximum loss possible on this trade, which is the total amount paid for the options, which in this case is $15.60. After that level, really, no matter where the market goes, really, now as you can see here, you have a market in which the real profitability is on a breakout on either side, and near the strike, where the market is in the middle, if it stays flat and quiet, that's where your maximum loss is incurred. So the enemy of this trade is a flat, quiet market, and if you don't see a breakout by the time that you want, you need to come out, or your position will be badly damaged by time erosion, and it may expire worthless altogether. On the other hand, the reason people put on these trades, as you can imagine, is if somebody thinks there's going to be a big breakout in either direction. So if somebody says, I really think this market can break out to 126 or below, or to, let's say, 138 or above, along with all these different numbers, they would contemplate this trade, and they would be monitoring premium constantly, because the values we see here are values intrinsically at expiration, but on a big move one way or the other, this premium, the 1.56 points in premium that you need to be to overcome, could be achieved quickly on a volatile move, so you need to continue getting prices on both legs. Although this trade is a spread, it's a non-margin trade, as we indicated, and it is possible for you to leg out of this trade or offset one side at a time. So for argument's sake, again, let's say you think this market's going to chop crazily, so it's going to bounce in one direction first. You can offset in one direction and then play out the other direction So there is some flexibility, and there are some follow-up adjustments on this trade, and you don't need to offset this trade simultaneously. Although it is a spread, there are two individual legs, there are two individual round turns, there are two individual fees for each leg, and they can be both taken out and whenever your thinking warrants. Again, for people, let's say somebody was more bearish than bullish, they want to pull out this trade. One simple way to practice this and to figure out your own trades is to say, you know what, I'm really bearish. I'm going to buy 2 puts and sell 1 call. It's no longer really a short strangle, but it gives you a different way of looking. So when you look at your break-even box and you think, well, this way I'll be, you know, my high break-even point is here, my low break-even point is here. Let's see how that changes. And again, you're going to save that trade and be able to compare. Let's see how that changes over here. And as you see on a drop, the numbers are much bigger because you have 2 puts instead of 1. The total outlay, because you put in 2 puts instead of 1, so you paid more premium, is higher. Therefore, your maximum loss is greater in a flat market. And on a rally, because you have to overcome the cost of 2 puts and you only have 1 call working in your favor, you would need a significantly larger move to the upside to overcome that additional cost. But again, on a big breakout, on an explosive move to the upside, you can even make money having just that 1 call against those 2 puts. Although in that particular case, you are being more bearish than bullish looking for a breakout. So you are better off on a big drop, but actually can do okay on a big rally too. You just fine-tune your opinion to reflect in this particular case, if it's the case being more bearish. And of course, you know, we can do the opposite as well, because there are as many opinions in the market as there are traders, and that's what makes the markets. Mark Twain wisely had said at one time, it's difference of opinion that makes a horse race. And believe me, if one person is going to buy that strangle, be long that strangle, some person is going to sell those options individually, or some person might actually be short that strangle. Again, as you can see, the middle zone has changed. Now it takes a bigger drop to start making gains because we were more long premium on the bullish side. On the other hand, because it's a very bullish trade, on a big rally, the numbers start getting bigger on an upside move. So again, you can modulate a long strangle. And again, this is different because it's a variable position size. The classic position is always to do a 1-by-1 ratio. Again, varying the 2 sides in this case will not add margin because you're only long premium. And finally, I can show a 2-by-2 as well. And as you can see, the numbers really start to grow. In this particular case, it's exponential because it's double position size. Now, let's look at somebody else. And the second case here will be a case of somebody who's trading the S&P 500 index and thinks something big is going to happen. Again, this trade is not a recommendation. We are not, in fact, many cases, as you will see, we're put on exactly opposite views side by side so that we can model the trades and understand the concepts. So just because we have an S&P trade here, a long strangle in the S&P, does not mean that we think the market has the conditions for a long strangle. Rather, we are showing people how a long strangle hypothetically would perform and what are the circumstances under which we consider a long strangle. Again, in many cases, this kind of, you just dismiss the trade. Again, here we're collecting call premium and put premium, as you can see. So we have an outlay. It's an expensive trade. It's a large contract. It's the S&P market, which, as you know, is 250 times the index. So we're talking probably over $450,000 worth of leverage right here. And as you can see, again, we have the strike examples. We have the premium example with learn more. And then we have the trade again. The inputs are automatic. These boxes come out automatically, so the only place where we can make changes is in these inputs, so that you cannot mistakenly input the wrong combination if you selected long strangle. Once you selected long strangle, the ingredients of long strangle are immediately appear, including the number of legs. In this case, it is 2 legs. Now again, we're looking at the particulars of this trade. is $57.50. So as I said, it's a big contract plus the fees. So it's $58.60 is the initial outlay up front. When you buy options, when you long premium, the trade is a debit. So the trade-off against that debit, of course, is that you have a limited and predetermined risk, which is limited to the cost in this particular case of that call and that put. This trade essentially gives you the right, but not the obligation, to do one of two things, either to be long at 1870 or to be short at 1820. And then let's have a look again. As you see, the risk is limited, but that's a fair amount to spend on an option. So again, in long premium. So if you don't see the market breaking out in either direction on a timely basis, you have to consider an exit strategy so that time decay does not entirely take away the value of the position. On the other hand, these are June positions, and if you feel that the market has a chance intrinsically of dropping, going above 1893 or dropping below 1796.56, that's intrinsic value. If you think it can get there quickly, this may be a trade for you. If you think the market's going to be flat and dead, this is not the trade for you. While putting on the trade, we are looking at two things. While we look at intrinsic value or in the money value, which is where the futures have to go beyond these levels, either drop below your low break-even or rally above your high break-even, what you are monitoring every day, and especially if you see any movement in the market or you're getting to a critical stage of monitoring, is you want to make sure that you spent 23.44 points, and you want to make sure that you can collect more than that in order to make money. Or if you are incurring losses, let's say if you see this spread is down 10 points. 10 points at 250 is 2,500. The market looks tame, nothing's going on. You might decide, to offset that position at the market and not incur the maximum loss. And again, selling at the market is a market order. You get filled where you get filled. In certain cases, you can use limit orders, which don't guarantee a fill. But in any event, I would monitor these trades closely. The reason people would do this trade is that outside this range of loss or with rising volatility, on a large contract like the S&P, the numbers can get pretty strong. It's not so long ago that we saw these markets flirting with the 1750 mark, 1760 mark. So presuming that we can drop to such levels or greater on anticipation of rising volatility, this type of long strangler or long premium trade, in that those levels will have made a sufficient move, a volatile enough move to become profitable, even if the call that you bought ends up losing money, because you just need a big move one way or the other that overcomes the entire cost of the trade. On the rally side, again, somebody who does this would have some sense that the market will explode in either direction. So by the same token, as you can see, if the markets do break out, and we're seeing some lofty numbers here, but again, some people do think that the markets are going to pick up some momentum. Some people think it's going to drop like crazy. That's what makes a marketplace. In a rising volatility environment, the one thing that you can't have is a trade ending up or floundering in a tight zone where the market expires. So again, whether you look at a chart or you get an advisory service or you do your own analysis or you have a dream in the middle of the night, if you're dreaming rising volatility but have no idea as to direction, you want to look at these trades and see if the volatility and the moves are sufficient, based on your opinion, to warrant the outlay of premium, as we have in this case. And finally, we have our third example, and this is an example using a stock, and we are using, in this particular case, we use Apple, which I think is around 522, 523 and change. And again, this is for a trade for somebody who thinks that Apple is going to explode one way or the other, and I believe these trades are a year out. So if somebody thinks that there's going to be an explosive big move in Apple in either direction and don't know where that is, but they think it's an explosion perhaps well above 620, 630, or in the alternative well below 425, 420, Somebody looking for a large, explosive move like that with rising volatility, hopefully sooner rather than later, would go ahead and consider putting on this trade. Again, because of the cost of the trade, as you can see here, it would be wise to maintain a real close outlook on the market and on the premium values of the position, so that if the market does not make the anticipated breakout, you follow up with some kind of an exit or a salvage strategy long enough before expiration so that you walk away with a respectable amount of your initial investment and mitigate your losses. Again, given the amount of time on a trade like this, legging out of a trade or adjusting to a trade like this is easily done. Our future webinars will follow such follow-up strategies. So let's say if we're in a market like this and somebody says, wow, Apple's down to 415, and let's say the option is worth this and not more with intrinsic value. Although if there's time value, that would be more. You check the premiums. You have to decide what to do. Do I take a profit? Do I think it's going to run back up and keep the other call, or do I salvage on the call as well? Do I reverse? Do I turn this in? Do I use my my put down here as a way to get long? Everything as your outlook shifts. And again, when you're looking at the dynamic option strategies, after a certain movement, after a certain change in volatility, your directional and volatility outlook will change as well. And when you do, obviously, correspondingly, as your outlook changes on direction and volatility, you make adjustments to your trades that are in accordance with that changing outlook. So as you can see, the calculations are in place for the stocks, as well as for bond trades, as well as for the S&P. So we can do an all-market calculation on long strangles. The difference between a long strangle and a long straddle, to be very simple, and we're going to run more examples of this after we begin our basic series next week, is that a long straddle is very similar to a long straddle. It's a strangle. It's a volatility play. So you're expecting a market to break out big in one direction or another, as we discussed. So it's the same. It's specialized. Use it with a strangle when you believe that the market's moving sharply in one direction or another. Profit is unlimited because a large move, a volatility rising move is basically the purpose behind the purpose and design of the trade. Because your long premium, it's a non-margin trade, so your loss levels are limited and predetermined to what you spent for the market. And those losses, again, as with a long strangle, will occur if the market stays flat in a narrow range. And again, same as the strangle, the time decay is the enemy of this trade. If time passes and nothing big happens, these options erode and will become worthless or close to worthless again. If both, in the case of a straddle where both options are at the money, it would really be an exercise in precision for both options to expire out of the money. However, if the market is flat enough near the one strike price, and in a straddle both options sold at the same strike price, as you can see here, the puts and the calls are at the same strike. So that you need a large breakout in each direction. The level of bullishness that you have in trades like this, whether you pick a straddle or a strangle, will depend on how extreme you think the rising volatility is going to be. If you think the rise in volatility is going to be extraordinarily extreme, and you don't want to tie a lot of money in the trade, you put on a strangle. The more explosive the move, the more you can go out of the money with the options that you buy, because your anticipation is of a bigger move. If you go at the same strike price, if you go at the money using the same strike price in a classic straddle, then your initial outlay will be greater as well. So your decision of whether or not you use a straddle or a strangle is really a function of how far you think the market's going to go and with what volatility. So you can look at different examples of that trade and play around with different strike prices to create a distance in the strangles, and try to come up with the combination that is most consistent with your outlook.
We have a question, Mr.
Okay,
Mueller.
go ahead. Sure, go ahead.
Does it ever make sense to do a straddle vis-a-vis a bull call spread versus a bear put spread?
This is, well, it's an interesting question for this reason, because you achieve two things. Number one, when you do a bear call spread and you do a bear put spread, you are still looking for a breakout in one direction or another. However, because a bull's call spread and a bear put spread are trades that do not individually rely on rising or explosive volatility, the rising volatility that you have in the closer to the money options, the call and put, may be negated to some extent on a rising volatility by the rising volatility of the options that you sold. So while the initial profitability, while the initial cost of the trade will be reduced because it is collecting premium, by selling that premium, the beneficial effects of rising volatility will be minimized. And the primary objective of doing a long strangle or long straddle may be negated because the rising volatility will go against the trades in either case. So let me give you an example. Let's say that, and I'll just go to one of these and try to provide an example. Let's say if these trades were done as bull spreads and call spreads, and the market explosively moves in one direction or the other. The short option on both sides, relatively speaking, will increase in volatility, although the one that's the one on the wrong side of the trade may lose value. So you have to be very mindful that when you change a composition of a trade like this, it's a change that may disappoint you if you actually get the big explosive rise in volatility, but by having capped the potential and change your overall deltas and thetas, which are time erosion measures and measurements of a futures against an option, you might nullify the effectiveness. So when you would do that is if you perhaps have a very long-term sense of a market trending one way and then maybe trending the other way, and you'll leg out of a trade. Or you think that you're going to come out in the middle and salvage premium on some rising volatility and leg your way out of the outside legs. When you do that, however, you are converting a non-margin trade into a margin trade. So if that's part of your plan and putting on a call spread and a put spread instead of an actual long strangle or a long straddle, you do have to understand that if your objective is to stay non-margin, then that adjustment possibility is also negated. So I think that for certain people under certain scenarios you can do it. Another case in which you can do it, let's say, is if you thought that you were extraordinarily more, you thought it was much more likely for a move to happen in one direction rather than the other. And then what you can do is you can do things differently. You can make the strike price closer or farther away. You can have a bull spread on one side and a straight out option on the other, a put spread on the a put on the other. So you can have a spread on one side and an outright on the other. And let me just give you a very simple example also of how you can change your level of bullishness or bearish. Let's go to the T-bonds trade, if I may. And again, we've pulled this up, and let's just go ahead on this trade and let me change one of the strike prices here. So let's say somebody is more bearish than bullish. So instead of changing unit size, we stick with a classical strangle, but we bring that position in a little closer. So let's say, for instance, how much is the 132 put? And then we're looking at the June.
It's trading at about 2 basis points.
2 basis points, okay. So when you look at this, as you can see now, you've spent a lot more money. Let me make more rows too, because these trades move out quite a ways. So let's see where we are. So now what you've done is obviously invested more in buying put than you've invested in buying your call. So although you're looking for an explosive move with rising volatility, In this particular case, it is with a bias for a downside move. And as you can see here, look how much more you spent on one option than the other. That shows a bias. Look at your total cost. And then whether you print out or whether you click back and forth between the two trades, as you'll see, you need a pretty good move to the upside to gain. But on a big drop, your risk is limited in the middle to the cost of the options, to the total cost of the options. So again, you have to watch your time erosion and your time decay so that the options don't go to zero, because we're just sitting on our hands. On the other hand, as you can see here, because you have an option that's closer to the money, the break-even point on a drop is closer. The profitability level picks up on a drop also much more quickly. So one way to adjust your, although you may have a volatility outlook and be non-directional, you can have a certain level of direction based on selecting how much premium you're going to pay and which strike prices you're going to buy in accordance with your beliefs. There are various kind of bracketing plays, strangles and straddles, where you can use combinations. So you have there are butterfly trades, there are condors, there are all kinds of trades in which you have a combination of long and short premium. The trades we're looking at right now are really volatility only trades looking for a big breakout. So I'd say that using spreads, bear put spreads, bull call spreads are more directional in nature and less volatility based. So we would be we're kind of mixing our apples and oranges if we do that. Any other questions?
Not right now, no.
Okay, well, I want to thank everybody for participating. I had a good time. We're going to go ahead tomorrow. We're going to do some follow-up trades, and we had some exciting trades over here on the from the last couple of weeks. We got some S&P follow-ups. We're going to be looking at sugar. We're going to look at some T-bonds. I don't know if there's be much to look at based on today's trades. And then on Thursday, we're going to be doing the exact opposite of today's session. Today's session is about what do we do if we think there's rising volatility but don't have a sense of direction. Thursday, we're going to go into the opposite scenario, and that's going to be the scenario of short straddles and short strangles. So here, it'll be the same, non-directional. We don't know where things are going, but we think things are going to quiet down. But in this particular case, we're going to be selling options and collecting premium rather than buying options and paying premium. And you'll see that the tables and the graphs are actually curiously opposite each other. As you can see here, the long straddle and the short straddle are the same thing except upside down, and the long strangle and the short strangle are the opposite as well. These are mirror images of opposing views. Today's we're on rising volatility. Thursdays will be on falling volatility, and with those as the only factors in our decision-making process. So I think it's a good balanced approach to understand the trades and to understand premium. And if you have anything that you would like us to model or demonstrate prior to Thursday, please go ahead and send us the request, and we're going to demo those trades as we have before. Next week we are beginning from scratch with our demos, with our basic program about the foundations of trading, buying calls, buying puts, writing calls, writing puts, and of course getting long and getting short to the underlying stock or futures. So we're looking forward to picking it up next week, and I want to thank you all for participating. Keep on studying. Be sure to log on, register, log in, and start practicing with your own trades. I can assure you it is our intention, and it was the purpose of our design to make this a very easy tool to use. So we want you to go ahead and go in there, set up some trades on your own, or ask one of our program people or coaches to do some trades with you so that you can be set up and start practicing using the tool. So again, I enjoy everybody's participation. Please give us more feedback so we can continue to improve our tools and our software. Have a super day.